Welcome to Frank Wealth Insights, a financial and investment podcast from Return on Life Wealth Partners. They look at your money. We look at your life at returnonlifewealth.com.
Welcome to the latest episode of Frank Wealth Insights podcast. I'm your host, Frank Fantozzi, and joining me today is one of my team members and wealth advisors from Return on Life Wealth Partners, Danielle LeChard. On today's episode, we'll be discussing 529 plans, which are also known as qualified tuition plans. Welcome, Danielle.
Hi, Frank. Thanks for having me on today. I'm excited to be here.
Yeah, we're going to have some fun talking about saving for college. Okay. Before we start diving into 529 plans, we want to share that there are two types of 529 plans, a savings plan and a prepaid tuition plan. Both are generally sponsored by the state, and they are state-specific. Each plan does have its own eligibility requirements, so please consult your financial advisor, CPA, or legal counsel for more information. So to get things started, Danielle, what is a 529 plan and how does it work?
So a 529 plan, Frank, it's one of the best saving techniques that we tell new parents or parents of any age to start saving for their children. It is a tax advantage savings plan designed to encourage saving for future education costs. They are legally known as qualified tuition plans. They're sponsored by states, as you said before, state agencies or educational institutions.
So as we started, there are two types of 529 plans. One is an education savings plan in which parents or grandparents, whoever is contributing to the account, is putting actual hard dollars in. The other is known as a prepaid tuition plan. And in a prepaid tuition plan, you're basically buying credits that are used normally within the state that the plan is sponsored. Most education savings plans are available to everyone, but a few have residency requirements for the saver, or basically the founder or the account opener, and one for the beneficiary. Prepaid tuition plans also technically have residency requirements, and there's one exception, and that is the prepaid tuition plan sponsored by a group of private colleges and universities.
So Frank, what's the benefit? So, you told us about what a 529 plan is. What's the benefit tax-wise associated with the 529 plan?
Well, this is one of the only vehicles we know that if you follow all the rules, basically the money comes out tax-free if it's used for appropriate expenses, which we'll talk later on the podcast. So the big benefit here is there's no tax deduction. However, any monies contributed to the 529 plan, if they're invested into a savings program, those earnings grow tax deferred. And if you meet the requirements of the 529 plan and you use them for qualified tuition and things like that, the monies when they're withdrawn will come out tax-free. So there's no other investment vehicle really out there that could be used for college in this manner.
Okay, so that's helpful. Since you're on kind of what kind of expenses are qualified, I have a couple that I'll read off here. So qualified 529 expenses are tuition and fees, room and board, textbooks and supplies, computer and software, other materials directly related to school, apprenticeship expenses, and special needs equipment. In addition to that, you can also withdraw up to $10,000 per year for qualified K through 12 tuition expenses. Is there anything I missed there, Frank?
Well, one little distinction: if you use the prepaid tuition programs are basically, as they state in the title, it's for tuition only and any mandatory fees. So there's a slight difference between the two. So in regards to, one of the common questions we receive from, clients all the time is, we never know what our total college tuition is going to be. So one of the things we do as financial advisors, we sit down with clients with their young kids and say, we talk to them about how much do you want to contribute, how much can you afford to contribute, and we try to estimate based on past information what college expenses are going to be, 18 years from now. So when you have a newborn and you want to send them off to school, there's money available. But what happens, and this is again a common question, what happens if you actually save too much and I have excess money in the plan? What are my options? if my child doesn't go to school or receive a scholarship, what are the flexibilities with the 529 plan? What can I and can't I do?
So there's a few things that you can do if you oversave. So the first thing is if your child decides not to go to college or not to use any of those funds, you can transfer the money in the 529 to another designated beneficiary. What we mean by designated beneficiary is it has to be a family member. That includes you can transfer it to a parent, a step-parent, even a grandparent, a different child, a different sibling, even a stepbrother, stepsister, grandchild. So there's a lot of flexibility when it comes to transferring ownership of the 529 plan. So that's option number one. The second option, if you save too much, is there's actually a new law that was put into place that will allow you to transfer funds into a Roth IRA for the beneficiary. And a little bit of clarification here. So let's say your child is they just graduated college and they have no plans on attending graduate school. So each year, you can open a Roth IRA in the name of the beneficiary, and each year you can transfer the maximum allowable limit to that Roth IRA. So for example, 2024, you would be able to transfer $7,000, and you can do that each year for the maximum amount of $35,000. So those are a couple of the things that you could do. There's also, if we're going to talk about, straight withdrawing the funds, if you have leftover assets and the beneficiary wants them right away before retirement, you do have the option to withdraw the funds for non-qualified expenses, but you will receive a 10% penalty and income taxes for that. So those are the few options there.
Yeah, and that's a great point that, great flexibility with the new act that they came out, new tax act, to address, the need for additional savings and to not penalize people because they oversaved. But the key thing to point out is if I am the beneficiary and I'm making Roth contributions, if I am doing this Roth conversion, to the maximum limit of $35,000, I cannot, in addition, make my Roth contribution. So it's an either or decision-making process. But again, it's a great benefit if there's really no ability to take the excess savings and redirect it to another beneficiary. But one of the things we do from a planning standpoint, and it becomes more of legacy planning, is that there is no time limit on how long monies can sit in a 529 plan. So if your child, is planning on getting married at some point and having children, you can still maintain the count and use that money to offset future costs for your grandchildren. So it doesn't mean that there's a time limit that you have to pull the plug and get the money out of the 529 plan. You could leave it in your child's name. You could name yourself the beneficiary. And then when you have grandchildren, you could actually change that money to that point in the future. So most of the time, we find it very rare that someone has to take the money out for non-qualified expenses, pay the 10% penalty, and pay the income taxes associated with it. And then when you want to get into advanced planning, we've actually used, for clients who might pay estate taxes, we've actually set up 529 plans and max fund that money up to the state limit. Now, keep in mind, these are gifts. So one of the things you have to be clear about, and you have to work with your CPA, is that the donor who sets up the account has limitations in regards to what they can do from a gifting standpoint if they want to avoid, paying gift taxes or using up their unified credit, which applies to gift and estate taxes. So currently, under the current tax law, each individual is allowed to give $18,000 per donee per child. Now, as a parent, if you have one child, that means you can gift, under current tax laws, $36,000 a year. They also provide you a front-ended gift or front-loaded gift where you can gift 5 years worth of contributions, which would be $90,000 per donor, or as a joint gift to a child, $180,000. In that situation, you wouldn't have to file a gift tax return, and then you would be able to get a huge jump start on the college savings plan. But I do want to ask you, though, Danielle, how does having a 529 plan impact financial aid and eligibility?
So in terms of financial aid and eligibility, when you're applying for financial aid, a 529 plan, it will impact financial aid. It is generally considered assets of the parents and the grandparents. So with that being said, that is something to keep in mind. For scholarship purposes, you can receive scholarships and also still be eligible to use your 529 funds. If your student were to receive a full scholarship and they didn't need the 529 money for tuition, then they could still use the 529 funds for different expenses like books and room and board. So you can double those up. In terms of withdrawing after receiving a scholarship, so let's say your student receives a scholarship, but he still wants to take the distribution of the 529 funds. So let's say that the scholarship was $10,000, and in order to pay for some fees, your student takes out $10,000. Typically, there's a penalty, but in this case, if you're doubling it up with scholarship funds, the penalty is not applicable, but the student will have to pay income tax on that $10,000 that he withdrew. Does that help answer your question there?
Yeah, so what I'm hearing is if my child receives a scholarship, if I choose to, I can take an amount out equal to the value of that scholarship. I avoid the 10% penalty, but I would have to pay income taxes on any of the monies that accrue from the investment earnings.
Yes, that's correct.
Okay, great. Now, what happens if I move to a different state? Am I obligated to continue to use my state-sponsored plan, or can I go to a different state or use different plans? How does that all work? Because obviously every state has a plan. What are my options as a parent?
So here's what you can do. So you can transfer the funds in a 529 plan from one state to another through a direct rollover from the old 529 to the new state's 529 plan. You can also transfer the 529 college savings plan through a distribution contribution combination. So there's two different options there. We prefer to lean people towards the direct 529 rollover because in a lot of cases it's more simple. But you can also, take the funds out and then put them back into a new fund. So a couple different ways.
A lot of flexibility in that regards. One of the things we wanted to talk about, again, we spoke about this at the beginning of the podcast. You really need to consult your financial advisor, legal counsel, or your CPA, because these plans are very state specific in regards to limits from a contribution standpoint, total growth of the account. So that what that means is how much can that account grow to before it reaches a maximum amount allowed by that state. And each state sometimes have tax preferences. So while you really do not receive outside of the tax deferral from the federal government, there's no federal tax deduction. However, and we're going to talk about the state of Ohio. In the state of Ohio, you're allowed per person or per donee to receive up to $4,000 contribution per donee / beneficiary. So whoever makes that donation, so in other words, I could set up an account and for my son, and I decide not to make a contribution this year, but if the grandparents decide to make a contribution, they would receive up to $4,000 deduction on their state of Ohio income tax. So again, this is very state specific. So please look at your own state rules. And that's what sometimes influences people in selecting 529 plans. One of the decisions is, well, I like this company and their investment options versus this company. Well, that's great, but if your state is underwritten by a different investment company, your tax preferences are going to be tied to the state-sponsored plan, not to the out-of-state plan. So you are allowed to, for example, I'm in Ohio, I could use the Virginia plan, or I could use the Delaware plan, but then I would give up the state-specific benefits. So there isn't a restriction that you're forced to use your state plan. So sometimes people will make the decision that, well, this is my state plan and I don't like the investment options, because the $4,000 in the state of Ohio times 3% tax rate, average tax rate, that's $120. And as an investor, one of the decisions I have to make is, okay, that's a little money I save in the state of Ohio. However, if I really don't like the investment family and investment options and I prefer another state plan, I might be willing to forego the $120 savings because I like the investment options from another estate plan. So again, that's something that you can discuss with your financial advisor, CPA, or legal counsel. So how do I go about doing this? How do I set up a 529 plan, Danielle? What's really involved?
So there's going to be a few things that are involved. As you said earlier, it's going to be crucial that you talk with your financial advisor, your legal counsel, your CPA. Your financial advisor is going to help with a lot of things. They're going to be the ones ultimately deciding the investment mix. The time horizon is going to be very important. So you're going to need advice on, how to open the account, what investments you should be choosing. So the first thing you're going to do is talk to your financial advisor. And then there's a few other options that you have when looking at different 529 plans. There's a few for the state of Ohio. You'll work with your financial advisor to kind of determine which one is going to be the best for you and your student. And after that, it's pretty simple. After that process, you'll just have to get basic information together, like child's date of birth, home address, social. A lot of the same account, like typical account documentation that you need when opening a regular banking account is pretty much what you'll need to fill out for the 529. You will want to set up some sort of automatic transfer into the 529 account to fund it. So a lot of our clients, when they are putting together a 529 plan, they will set up automatic monthly transfers from their checking account just to put away into their students' 529. So
thanks. No, it's helpful because it's paperwork. Everyone loves paperwork, but to do anything in the financial world, it usually requires some amount of paperwork. Or as we're finding out now, a lot of things can be digitally handled.
Yes.
I do have another question. What happens if the account owner who set up the 529 passes away? Kind of take me through how I deal with that to make things less difficult on transfer and things like that.
So when you're first opening the 529, you will be presented with an application. On that application, it's going to ask you who the owner is of the 529, and that's also going to ask you about a successor owner. This is really, really important that you have a successor owner on. Let's say it's a husband and wife who open the account for their son, okay? The husband is the owner. He will want to put his wife or another, responsible party as the successor owner in case something happens to him. So, let's say the husband now passes away. Ownership will be transferred directly to his wife, and she will, handle the account proceedings as it's laid out pretty much in the documentation. So it's important that you have a successor owner on there. There will be no cease in, ownership authority if she's listed.
Great, thanks. Now, you always got to plan for all these various contingencies. And to be clear, there is a difference in working with a financial advisor or people that work in this, work for service. You can, with most states, again, you can do the prepaid tuition plan, which is really no cost. That's directly done with the state. You can also go on the state's website and work directly with the state and open up your own account and basically what I call DIY, do it individually, do it yourself. And so, the DIY approach is available to you, and you can open up your own account and then on the savings portion program, and then decide to manage the investment yourself. If you choose to enlist a financial advisory firm or an individual financial advisor, there are fees associated with it. So even if you work with, we're going to focus on the cash savings program, there are investment fees that are paid to the mutual fund companies that sponsor these, various 529 plans in each state. So you have to be cognizant as an investor what those fees are, because first of all, not all companies charge the same management fee for the underlying mutual funds. And then we also tell people cost is one factor in picking investments, but it's also the results and risk. So you need to look at, in our opinion, we believe you need to look at things on a net risk-adjusted rate of return to see if those funds compare well with the other funds. So you can take this all on yourself. Or if you work with a financial advisor, typically there are advisory-based 529 plans and commission-based 529 plans Unfortunately, there's way more commission-based 529 plans, just the way they're structured. It's not meant to be a turnoff for people when they hear the word commission. However, to enlist an advisor's time to help you, select the right account, help you with figuring out what should be your savings program, your savings cadence, how much you're going to need, and go through the investment decisions on building an investment portfolio. That's what you're paying for. So I think as a consumer out there, you have a choice. You can either pay for help or you can do it yourself. Just understand there's a lot of things to do if you decide to DIY it.
Okay, that's very helpful to know. So I mean, coming around here, who is able to who's able to actually open a 529 plan for a student? Is it just the parents, or is it?
Well, really anyone who's 18 and over can open up a 529 plan. So aunts, uncles, grandparents. We've seen this used often as a way. I've had numerous grandparents set up 529 plans, because you can have multiple 529 plans to the same beneficiary. So the parents might have an account, and the parents, obviously they give gifts and all that, but they want to give cash gifts. So they'll set up a 529 account. Maybe they open it as little as, $250, and then they'll put $50 a month into the plan. And then what they'll do, like on the child's birthday or their grandchild's birthday, is show them and provide an investment statement. Say, look, I'm contributing to help you towards college. So each child can have multiple accounts and multiple 529 plans in that regard. One question I do get often, especially nowadays, kids study abroad, and sometimes kids want to go to colleges outside of the United States. So one's easier than the other. If your child is in a study abroad program through a US-based university, the 529 plan is not going to be an issue in covering costs. However, if your child decides to go to England or to go to Canada to a university, you have to, there's a website that you can go out and look at to find out what are the eligible universities that will qualify and allow you to apply your 529 plans to actual residency and studying at a university that's located abroad. So that's a little trickier. You have to do a little more research to make sure that university is covered, if that's important. If your child wants to go to a famous college in again, England or Canada, and the 529 plan is not an issue, then you go to that college. But there are opportunities to use that, but there's a select requirement that these universities have to have, to qualify. The last question I get often is, mechanically, how does this work, right? So I'm in the savings mode, right? I'm saving. Now my kid's 18. Go through all the college visits, the hundreds of visits I have to go to find my right college for my son or daughter, and this is the one they pick. Now I start getting the bills, right?
Boy.
Yeah, that's no fun, but I've been good. My financial advisor, Danielle, has helped me figure out how much to save, so I am able to write these checks. But how do I take the money out of the account? And so this is really more of a tax procedure. So really, what you have to do is, when you receive your bills, so say I write a check for tuition and my bills, and my first check for the first half of the year is $20,000, right? This is going to make it easy, round it all up.
Yeah.
You have to have that documentation. The IRS requires you to keep that documented. And technically, by law, the expenses have to be incurred in the year you withdraw the money from the 529 plan. So I would submit this, and we're going to use the case that you're working with your tax professional and your financial advisor. Mm-hmm. I'm going to make a request to say, listen, I have $20,000 in receipts here. Please write me a check or withdraw $20,000. And so the financial advisor and their team will withdraw $20,000 from your account and reimburse you for that money. The challenge happens, and there's no clear rule by the IRS, but sometimes what happens is the expenses and reimbursement don't time up with the calendar year. So basically what we tell people is that you want us to be within 3 months of the end of the year. So if I have expenses for my child that relate to 2023, and I'm not able to pull all these receipts together, and I don't get them until 2024 and ask for the money in 2024, if I do it within 3 months of the year end, we have not seen a situation where the IRS has come back and denied, the distribution and forced you to pay income taxes and penalty. Again, there's no definitive rulings on this, but it's been pretty much a standard practice. We try really hard to advise our clients, try to make sure everything ties into the calendar year, the expenses and the reimbursement tied to a calendar year. But if you're within 3 months of the year end, we, in 20 years of managing 529 plans for clients, have never seen an issue come up for them with the IRS.
Yeah.
So is there anything else you want to add, Danielle, as we wrap up our podcast?
So one thing that I would like to add, just kind of a quick example here. I have one of my best friends had opened, she had kids 10 years ago. So when her first daughter was born, she opened a 529 plan, and she maybe contributed a couple $1,000s every year to the 529 plan. So her child just turned 18, and on the Ohio 529 website, you can see all of the contributions that have been made over time, as well as the earnings. So over the last 18 years, she has contributed around $60,000, and her growth on the account has been a little over $80,000.
So $140,000 is sitting in that account.
$140,000, wow. And we didn't really talk about how important compounding is, and how beneficial time is. So it's really important that you start this account young, and you'll have 15, 18 years to just let this money grow, let it double, and it's going to be a huge asset to the child once they reach educational age.
Well, that's a great story, Danielle. And yeah, Einstein always used to say the eighth wonder of the world is the magic of compound interest rates. So
yes.
That's awesome. Well, thank you, Danielle, for joining me today. And thank you to all our listeners who took the time to join us today. Understanding the differences between 529 plan types and specific state benefits is important. Understanding your options and planning for your college education is critical. It's one of the biggest worries we see our clients have with their children. We're trying to do something to help them, to give them a leg up, and college costs just keep rising and rising. So this is one of the best combatants we know to put yourself and your child in a position to deal with college expenses. Again, we recommend you contact your CPA or attorney to discuss your specific situation and needs, and any questions to help make very informed and clear decisions. If you have questions, please give us a call for any additional information. If you would like to learn more about how Return on Life Wealth Partners can help you pursue your important life goals, give us a call at 440-740-0130, or please visit us online at returnonlifewealth.com. Thank you, and make it a great 2024.
This has been Frank Wealth Insights, the financial and investment podcast from Return on Life Wealth Partners. Your life, your money, your way. Experience financial planning the way it should be, not the way they want it. See how at returnonlifewealth.com. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. This communication expresses the views and opinions of the participants as of the date it was recorded or indicated, and such views are subject to change without notice. This podcast is being made available for educational purposes only and should not be confused for any other purpose. The information contained herein does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities or related financial instruments in any jurisdiction. This podcast may discuss forward-looking statements that are based on then-current beliefs of the participants. Investment advice offered through Planned Financial Services, a registered investment advisor.